Hi there, you're watching Market Cafe on ET Now with me, Shreyanshi Singh, and over the next 1 hour, me and Snehisha will be taking you through news and updates from within the country as well as across the globe, also tell you which stocks you should be keeping on your radar. But then looking away from the world of stocks at this point, let's take a look at the political landscape. And as ever, Delhi has had a high decibel election. The incumbent Aam Aadmi Party is fighting to equal the Congress, Sheila Dikshit's record of a hat-trick, and the Bharatiya Janata Party. That's the one that's trying very hard at this point. Some may even call it desperate to regain control of the capital after over 26 years. In fact, the Congress, which had ruled Delhi under Dikshit for 15 years from 1998 to 2013, is just as desperately at this point trying to come out of its own political wilderness. Now, don't forget that this is the first big political contest of 2025. It could very well set the tone for other state battles. And Delhi, of course, has this diverse electorate spanning urban professionals, students, business owners, and migrant workers as well. So, in a sense, they do reflect India's broader demographics, and most exit polls at this point predict a BJP victory in Delhi. In fact, the JVC poll, that's the one that's expecting the BJP to win up to 45 seats, while Aam Aadmi Party could get anywhere between 22 and 31 seats. In fact, we caught up with Girish Kuber, who's the chief editor of Lok Satta, to gain more insights on the exit polls. Let's go across and listen into what Girish Kuber had to say.
We shouldn't compare or put any election as a kind of a reference on this or that, because there are a number of factors. Ideology doesn't matter these days. Political thought doesn't matter these days. What matters is your largesse versus my largesse. So if that's kind of a political system we are in. So that won't be the case as far as AAP is concerned. If at all it loses, it will be because of 10 years of anti-incumbency, the kind of desperation and power put by the BJP at every level, friendly lieutenant governor, friendly system. So it's in a way it's every state election. It's a highly unfair battle for every regional party. So I mean, there is no sympathy for AAP, absolutely not. But it's not. It will be difficult to put it as a kind of a referendum on AAP. And coming back to this point of surveys, I mean, last year we have seen how horribly wrong they can go. Except one state, and that too one survey, everybody was completely off the mark. So we shouldn't be jumping the gun as of now.
Well, Aam Aadmi Party's citadel of sorts at this point, and that's about Delhi. But let's also go across and listen into what the India Inc. leaders then are expecting from their leaders. Let's go across and listen in to what market honchos, in fact, our corporate honchos then had to say. Listen to the word coming in from Sunil Bharti Mittal, Rajan Bharti Mittal, as well as S.K. Munjal.
The new government must focus a lot on pollution. And I think other developments are happening, but I would say one thing has to be picked up: pollution.
Delhi, only one change, big change, pollution-free Delhi. Not for only us, for the next generation. That's the only thing.
I think there is a need to focus on things like infrastructure, things like air quality, things like traffic conditions, management of waste, drainage. I think these are important, while at the same time ensuring that we provide enough opportunity for all of the population of Delhi to educate itself, to skill itself, and to get the kind of opportunity that they need and deserve.
I want good development. This chaos which is going around, bad environment, roads are choked up and all, must be set right. And I believe, therefore, it should be effective government. And it comes only when the central and both the state government work together.
There are many things as a voter, as a citizen of Delhi we want. It's the capital of our country. So we definitely need the roads to be a lot better, in better condition. I think the pollution control would also help us a lot. And just faster development. I think more opportunities for our kids to play outside, to be more around. So that's what we're looking for: a healthy lifestyle, a better standard of living.
First thing is air quality, because I have three grandkids, तो वो बाहर ही नहीं जा पा रहे हैं, स्कूल बंद हो जाते हैं, तो एयर क्वालिटी इंप्रूव करना सबसे इम्पोर्टेंट है.
Okay, well, let's move on then and talk about the latest that's been happening when it comes to the Trump and India relations, especially on the migration front. And a US military aircraft landed in Amritsar yesterday carrying over 100 Indian illegal immigrants from the US. The flight was airborne for almost 24 hours, carrying deported Indians from the US, a part of Trump's deportation drive. India's foreign ministry has extended support to the Trump administration to help make the process as swift as possible. And in light of this move by the US, we spoke to Veena Sikri, the former High Commissioner India to Bangladesh, and discussed with her concerns surrounding Bangladeshi illegal immigrants in India. Let's go across and listen in.
The illegal immigrants from Bangladesh are the largest in number. Somebody has quoted, I think this figure has even been given in Parliament, the huge number of 2 crores, 20 million, which is a very, very big number indeed. And I think that this example, the way President Trump is giving the highest importance to this deportation of illegal immigrants, India too should be thinking along these lines. It's a very, very important issue because we do know already in the last 6 months, there have been moves in our neighborhood in Bangladesh. The Pakistani-Bangladesh cooperation is suddenly, jumped from zero to a very high aspect of Bangladesh's foreign policy. There is every important reason why India should be looking at deportation of illegal immigrants from Bangladesh living in India. Sometimes this process has to start very slowly, 10, 20, 100, but you have to start somewhere. Every drop makes an ocean, and the sooner you start, the better it is.
Okay, so that's the word coming in from experts on everything that's been happening when it comes to Trump's deportation plan of illegal Indian migrants staying in the US. But with that, let's also shift focus and talk about the global markets move yesterday. And it's been another good day of trade coming in for the US, back-to-back gains coming in. But when you talk about US stock futures, they were little changed last night after the major averages posted back-to-back winning sessions. The moves followed a second day of gains for the major stock averages. The Dow has added more than 300 points or 0.7% during the day's regular session. S&P 500 and Nasdaq have also gained 0.4 and 0.2% respectively, aided by a jump in the Nvidia shares. Now, investors seem to shake off worries around tariffs, which began on Monday after President Donald Trump announced a 10% levy on Chinese imports over the weekend. Sentiment has improved after the president paused duties on Mexican and Canadian goods. What's key to note is that the US VIX was lower by 8.5% yesterday. So that is another positive development for the US markets last evening. Big companies are set to report their earnings today, including Eli Lilly, Yum Brands and Amazon. Traders will also be watching out for the latest weekly jobless claims. So that's the lowdown coming in on the US markets. Overall, it's been a good day of trade for the US. Dow is leading the market move yesterday. But while that was the equity check, Shreyansi, take us through what commodities are doing.
Well, absolutely good day for the US. Can't say the same about oil prices though, because oil prices fell more than 2% as a large build in US crude as well as gasoline stockpiles is something that's signaled weaker demand at this point. While you do have worries about a new China-US trade war, that is also something that also fueled fears of softer economic growth. So that's what you're looking at in terms of factors. When you take a look at price levels, then Brent crude is the one that settled down over 2%, and $74 per barrel is the kind of level that you were looking at least as far as Brent was concerned. Even when you take a look at US WTI, 2.3% downtick coming in for US WTI, and $71 per barrel is the kind of level that you're looking at there as well. Now, US crude oil inventories rose sharply last week, and that's according to the data coming in from the EIA. And this is, of course, as refiners are facing soft gasoline demand, and there's some maintenance work as well. So that's important to look at. But there's also concerns over a new trade war coming in, brewing between the US and China. That's something that I've mentioned. And of course, the world's largest energy importer is going to be in the spotlight. That is something that you're looking at. Lastly, in terms of other factors, you do have Iran's president who's urged OPEC members to unite against possible US sanctions after Trump has gone ahead to say that he's going to be restoring the maximum pressure campaign on Iran that he had enacted in his first term. A quick reminder that Trump drove Iran's oil exports to near zero during part of his first term. And that was after reimposing sanctions to curtail the country's nuclear program. So that largely is the kind of factors that we're looking at as far as oil prices are concerned.
Okay, so that's everything that's been happening on the commodities front as well. Let's get a little stock specific now and bring you all the top global stories from the US first. In US, automaker Ford Motors is projected up to $5.5 billion in losses on its EV and software operations this year, a loss similar to last year and a sign of the severe difficulties in cutting costs on battery-powered models. Now, the 2025 profit forecast too was lower versus the figure in 2024. Additionally, CEO Jim Farley said that if the Trump administration is going to implement tariffs affecting the automotive industry, it should take a comprehensive look at all countries. Farley singled out Toyota and Hyundai for importing thousands of vehicles annually from Japan and South Korea that have little to no duties versus the 25% tariff to be imposed in Canada and Mexico.
Alright, then moving on, Qualcomm reported better than expected fiscal first quarter results coupled with a strong guidance for the current period. The most important market for the company is mobile handsets. That's the one that grew 13% on an annual basis to $7.57 billion in sales. In fact, the company chief also sees big demand coming in from customers in China for expensive premium tier smartphones. Then, and additionally, they also expect handset revenues to grow 10% when it comes to this year.
Okay, moving on then. Interesting survey from JP Morgan Chase shows that traders across the globe now expect tariffs and inflation to have the biggest impact on global markets in 2025 as they brace for volatility. A little over half of the respondents named inflation and tariffs together as the top potential developments likely to dominate markets this year. However, on the flip side, fewer traders believe that a potential recession could move the markets this year, 7% compared to 18% in 2024. When asked about the biggest challenge in 2025, it was volatility from the word go, repeating the last year's concern as well. This year, 41% of respondents cited it as the top challenge, while 28% of the respondents mentioned it in the 2024 survey.
Alright, then let's get you some key commentary coming in. Chicago Federal Reserve President Austin Goolsbee warned that ignoring the potential inflationary impact of tariffs would be a mistake, citing the COVID-19 pandemic experience where supply chain disruptions drove up inflation. In fact, according to him, the US economy is strong, the labor market is plausibly at full employment, and inflation has come down and is approaching the Fed's 2% goal. So that's important commentary coming in from Austin Goolsbee there.
Well, all right, lots of important commentary trickling in from the Fed and lots to watch out for today on the ECB terms as well. But on that note, we'll slip into a very short break on this edition of Market Cafe and be right back with the Asia markets and what they're up to this morning. So you stay tuned, we'll be right back.
Welcome back. Thank you so much for staying tuned in. Well, as promised, let's take a look at the Asian markets then. And when you take a look at the Asian markets, at this point, it does look like a sea of green at this point, because tracking gains on Wall Street is what Asian markets are up to. Firstly, let's take a look at Japan's Nikkei. That's the one on your that's the one that should be reflecting on your screen shortly. ASX 200, of course, holding on to gains of just about over 1%. At this point, Nikkei is the one that's up 0.2%. Even when you take a look at Hang Seng as well as Shanghai, both of them holding on to a tinge of green at this point. So Hang Seng on your screens, 0.1% uptick coming in for that one, and even Shanghai is up 0.2% thereabout at this point. So largely that's the kind of levels that you're looking at, 0.1% uptick for Shanghai just at this point. And when you take a look at South Korea's Kospi on the flip side, on your screens down 0.6%. Now that largely is the kind of handover. So barring South Korea's Kospi, everything else is pretty much a shade higher, 1% uptick coming in for ASX 200, and except that, just a tinge of green coming in for all the other indices. Now, in terms of what happened back home, of course, we shut shop around the 23,690 levels, and currently what is being penciled in is a gap up open. A very good start is what we're looking at this point. A very good handover, Snehi, coming in from Asia as well as Wall Street. So looks like we're going to have a very good trade day coming in trade as well.
Absolutely, because implied open is above that 23,800 mark. Remember, we've just closed 4 points shy of the 23,700 mark yesterday. So at least on the spot, it's indicating a 100-point gap up for us. But then, well, today also is the expiry day, so that is also something that you need to bear in mind and expect some volatility on that front. If at all, that would not be surprising. But on that note, here's everyone who's joining us on the market today, starting at 9:20. We'll be joined by Atul Suri of Marathon Trends, PMS. And he'll be here to talk about the mega trends that he's spotting and what's looking good on the street right now. At 9:40 a.m., we'll be joined by Upasana Chachra, the Chief India Economist at Morgan Stanley, to talk about what we can expect from the policy announcement tomorrow at 9:50 a.m. Then we'll be joined by the management of Swiggy. Rahul Bothra, the CFO, and Rohit Kapoor, the CEO of Swiggy Food Marketplace, will be joining us to discuss their Q3 numbers and the growth outlook going ahead. Keeping it with earnings at 9:55, we'll be joined by Sachin K. Gupta, the founder and CEO, and Nitya Balsubramaniam, the CFO of Inventurous Knowledge Solutions, to talk about how Q3 has shaped up for them. Lastly, to discuss fund flows at 10:05, we'll be joined by Radhika Gupta, the MD and CEO of Edelweiss MF, to talk about the newly launched consumption fund as well. Lots to watch out for in today's edition of The Market. Lots of prominent market guests as well as managements to watch out for. You stay tuned to the channel today.
Well, that's a power-packed lineup for you right there. Welcome back. Thank you so much for staying tuned in. Well, all eyes are definitely on the MPC meet outcome. In fact, the street is expecting the central bank then to cut rates by 25 basis points in this meeting. We have Gaurav who's standing by to tell us what exactly is being penciled in.
Well, yes, MPC meeting will conclude on Friday, and when it comes to MPC meeting's outcome, now the much awaited rate cut might happen in this meeting of around 25 basis point. And it's not just us, around 72% of the economists believe that RBI will go ahead with the rate cut. And there are several reasons why they believe that rate cuts may happen. The first is India's GDP growth. So when we look at the trajectory of India's GDP growth, for the last 2 quarters, the GDP growth has been slower than what the street was expecting. In fact, in the last quarter, which was Q2, the growth came at around 5.4% versus what it was estimated at 6.5%. So earlier RBI was focusing more on inflation, but in this meeting they believe that RBI may focus more on bringing back the growth, and that is the reason why they believe rate cuts will happen. Second is the system liquidity. Now when we look at this number, system liquidity is at a deficit of around 3.1 trillion rupees, and when we look at RBI, we have already seen RBI taking strict actions to bring back some of the liquidity. We have already seen RBI doing some of the activities like OMO, VRR to infuse around 1.5 trillion rupees in liquidity. We have also seen RBI cutting their CRR rates in the last meeting by 50 basis points. Now, although CRR rates are back to where it was earlier, there are no expectation that CRR rates may get cut from here on. But apart from that, RBI seems to be back in action when it comes to liquidity, and that is the reason why rate cuts may happen. Third is inflation. When we look at this number, it was actually higher than expected. In fact, food inflation was something which was stressing it out. But when we look at core inflation, it was well below the 4% mark where RBI wants inflation to remain for India. Lastly, when we look at food inflation, now brokerages believe that from here on inflation will ease off. In fact, brokerage like BOFA believes that in the month of January, we may see inflation reaching around 4.4% level, which is much lower than what we have seen earlier. And we have also seen government actually pushing the consumption. In fact, in this budget, they have been very clear about consumption push, and this is something which is also pushing the expectations around RBI's rate cut. When we look at RBI's another expectation and any of the projections, we've already seen RBI has cut down their growth estimations and also increased their inflation estimations in the last meeting. So we're not expecting any kind of changes there. But at the same time, any kind of commentary on the global macro events and any kind of commentary on from newly appointed Governor, Mr. Sanjay Malhotra, is going to be a key thing to watch out for. But when it comes to rate cut, now street is expecting some kind of rate cut around 25 basis point in this meeting.
Thanks, Gaurav, for taking us through that. Hold on and be with us, because we'll also be discussing what numbers are expected from SBI today. Before we do that, let's talk about Swiggy's Q3 numbers, and they've largely been a miss compared to what the street was expecting. Let's take a look at what Swiggy has done in Q3. Revenue has come in at 3,993 crores, which is an uptick of 11% in line with what we were expecting. Calculated EBITDA loss, however, has widened on a sequential basis at 726 crores compared to 555. We were expecting 535, so big miss on that front. Net loss also has widened, contrary to what we were expecting, at 799 crores. We were expecting a number of 620 crores. We were actually expecting a reduction on a sequential basis. This loss has widened, so once again a big miss compared to what we were estimating. Food delivery business, however, has done pretty well. The GOV has gone up by 19.2%. We were expecting 20%, so largely in line, no problem over there. Quick commerce, however, the GOV has gone up by 88%. Expectation was 100%, and GOV for home consumption looking good at 68% on a year-on-year basis, but overall mixed to rather miss set of numbers coming in for Swiggy for Q3.
Well, absolutely, and it's also India's largest lender, SBI, that is going to be in focus on the back of its third quarter results. In fact, Gaurav is standing by to tell us what exactly is being penciled in when it comes to SBI as well.
Well, yes. When it comes to SBI, which is India's largest bank, now Street is expecting higher than expected and higher than industry advances growth in this bank. And at the same time, NIMs are likely to stay stable. And at the same time, asset quality will also stay stable, which will actually aid the growth for SBI from here on. So let's look at the numbers first. When it comes to advances, they're expecting around 14% growth in terms of advances on a YY basis, while deposits may grow at a rate of around 11%. Now, that won't be a constraint because SBI has a low CD ratio, and that is the reason why advances growth will not be constrained by the deposit growth. And at the same time, when it comes to net interest income, they're expecting around 7% increase. Now, there may be some pressure in this front because of the global margins and global yield which is rising, and that is the reason why net interest margins may also decline marginally by 2 basis points sequentially for SBI. On the other hand, when we talk about PPOP, now cost to income ratio is likely to remain low, and that is the reason why PPOP may grow over 20% on a year-on-year basis. When it comes to provision, they are not expecting any kind of risk in asset quality, and that is the reason why provisions may remain low. In fact, credit cost is also likely to remain at around 0.5%, and that is the reason why when it comes to profitability, it can grow at a rate of around more than 70% on a year-on-year basis. Now, let's not forget that in the same quarter last year, there was an impact of wage rate revision, and that is the reason why these numbers look elevated. But even if we exclude that impact, SBI's numbers are likely to stay healthy in this quarter. Lastly, when it comes to commentary, any kind of commentary on the NIMS trajectory, how the slippages are going to turn around in Q3, because slippages are usually high in Q3 because of the agri segment, is likely to be a key thing to watch out for. And any kind of commentary around the rate cuts, because SBI has high rate of MCLR rates, which are repo link rates, and that is the reason any kind of commentary around that is also going to be something to be watched out for. But overall, when it comes to number, we are expecting good set of numbers from SBI in third quarter.
Numbers to be expected from SBI. Thanks, Gaurav, for taking us through that. Let's also talk about what kind of numbers we're expecting from Britannia, because that's another Nifty major. Remember, there are 6 Nifty companies coming out with their earnings later today. So from Britannia, on a consolidated basis, we're seeing revenue to grow up by roughly 6% at 4,500 crores. EBITDA expected to inch down by 6.3%. PAT is also seen down at 7% at roughly 517 to 520 crore rupees. Margins are expected to come under pressure at 17% compared to 19.3%. Now, EBITDA and margins are expected to contract on the back of raw material inflation, and 5% volume growth in biscuits is what we are forecasting when it comes to Britannia. However, let's also talk about ITC, because even ITC's quarter 3 numbers are to be released later today. On a standalone basis, we're expecting the revenue to go up by 12% at 18,456 crores. EBITDA is seen at 6,400 crores, which is an uptick of 6.3% year on year. However, year 2, we are building in some pressure when it comes to the PAT, expecting a cut of 5% at 5,290 crores on a year-on-year basis, and margins are expected to be under pressure slightly as well. Cigarette business volume, we're seeing anywhere between 3.5% to 5%. Paper is expected to be flat. Hotels and agri supposed to be good for the company. So that's the lowdown on what we can expect from both ITC and Britannia later today.
Well, absolutely. Lots of companies, 6 in fact to be precise, are going to be reporting their numbers from the Nifty pack. But that's telecom major Bharti Airtel. That's also all set to report its numbers. And in terms of what's being penciled in, robust profit growth and healthy subscriber addition is what we're looking at. In fact, Ansh is standing by to give us an update on what exactly is being penciled in.
Well, expectations are strong on the back of July tariff hike impact and consolidation of Industra earnings as well. Revenue is expected to rise by around 6% to 43,955 crore. EBITDA is projected to increase by 6.6%, with margin improving to 53%. If we talk about net profit, then that is likely to jump by more than 45% to 5,270 crore. Subscriber base is expected to increase by 30 lakh user. ARPU is projected to rise by 6.5% to 248 rupees. Now, if we talk about segmental expectations, then the mobile service revenue is expected to grow by over 4% sequentially. Home broadband revenue could rise by around 7%, supported by strong net addition, whereas the enterprise business is likely to be flat on quarter-on-quarter basis. Lastly, let's have a quick view on few factors to watch out for. First is progress on 5G implementation. Second is capex, and third is future tariff hike. So overall, a strong set of numbers are expected here.
Okay, expecting a good set of numbers from Bharti Airtel as well. But on that note, we'll slip into a very short break and be right back with more stock-specific news and updates on the other side.
Welcome back. Thank you so much for staying tuned in. Well, time now to get to the futures and options roundup. In fact, Ansh is standing by with just that. Ansh, over to you.
So let's start with Nifty first. As you can see in the chart as well, Nifty actually touched its 4-week high level, but then it closed slightly in red, but still it is sustaining above that key level of 23,550, which is a positive sign. Whereas on option front, we are seeing some active call writing happening at 23,800 level, indicating that option traders are expecting some resistance around this level. So 23,800 is the one which you should watch out for, and on downside 23,550 is the one which could act as a support. Now if we talk about Nifty Bank, then Nifty Bank also touched its 4-week high level, closing in green, and also it has been sustaining above that 50,000 mark, which is also a positive sign. In index future, we are seeing that open interest has gone down by around 3%, indicating short covering, which is again one of the bullish sign here. Now if we talk about FI position, then in index future they have added around 3,400 contract. They have covered around 500 contracts. So net to net we are seeing addition of around 4,000 contract on upside. But at the same time, if we talk about client position, then in index future they have actually covered their long by around more than 1,000 contract. They have added some shorts as well, due to which we are seeing that they are getting on a bearish front. But if we talk about FI position of last 3 sessions, then we are seeing that their total long position has been increasing from 10.5 to 16.8 to 18% now, indicating they have been adding longs and getting on the positive side.
Okay, thanks Ansh for taking us through all of those key levels to watch out for and everything that's expected to happen in the F&O market today. Especially important to watch out for since today is the weekly Nifty expiry. But let's also take it across to my colleague Ria, who's standing by with a list of all the stocks that could be potential buzzers in today's trading session. Ria, take it away.
Yes, good morning. Let's take a look at the stocks that are going to be in focus today. First up, we have Cummins India on the back of its Q3 numbers. Now remember, yesterday the stock had gone up around 3% after positive commentary from the global parent. But looking at the Indian entity, the revenue has gone up around 22% on a year-on-year basis. Even the net profit has surged around 12%, coming in at 558 crores in this quarter. The EBITDA has also gone up around 10% over the previous year. But if you look at the margins, those have contracted by around 205 basis points over the previous year, coming in at just about 19.3% in this quarter. We also have Aarti Pharma reporting its numbers. Quite a good set coming in here. Revenue has gone up almost 20% on a year-on-year basis. Even the net profit has seen a very good surge of more than 40% over the previous year. EBITDA is also up around 35%, and the margins have gone up by 259 basis points, coming in at 23.9% in this quarter. Kansai Nerolac has also reported quite a good set of numbers. Revenue has gone up just about 0.2%, so marginal increase there. But the net profit has surged 341% over the previous year. EBITDA has gone down slightly around 3.5%, and margins are down around 47 basis points on a year-on-year basis. Looking at Skipper as well, good set coming in here as well. The revenue has gone up more than 40% over the previous year. Even the net profit has surged 76% on a year-on-year basis, and the EBITDA has gone up by around 45% over the previous year. Lastly, also keep your eye out on CCL products. They've reported a mixed set of numbers in this quarter. The revenue is up around 14% on a year-on-year basis. The net profit is down slightly, just about 0.4%. The EBITDA has gone up around 12% over the previous year, and the margins have seen a decline of around 29 basis points, coming in at 16.4% in this quarter. So keep your eye out on all of these stocks today.
Well, absolutely. Thanks, Ria, for getting us that check going on the stocks that we should then be watching out for in trade. In terms of the factors that we're looking out for, of course, it's the capex recovery that we're keeping an eye on, the pecking order when it comes to capex versus consumption. And other than that, of course, there's a much needed boost for urban consumption that we're looking at. Other than that, there's Trump's tariffs in terms of factors. And against this particular backdrop, we caught up with Swanand Kelkar, who's the managing partner at Breakout Capital Advisors, who in fact then shared his views coming in on sectors as well as stocks where he sees pockets of value then emerging. Let's go across and listen in to what he then had to say.
Autos is largely consumer discretionary. There are a few EMS and consumer durable names. Those also look good. I count real estate as consumer discretionary. It might be a separate sector altogether, but all the macro factors that make you buy a car also make you buy a house.
But housing is like investment of your lifetime.
Yes.
Buying a car or buying a toaster is additional cash which you save, you buy.
Yes.
But why would you call real estate as consumer discretionary?
So what are the factors that help a consumer discretionary name? And let's include real estate in that basket. Your income has gone up in your hands and you feel reasonably good about your income prospects, right? That's when you're going out and doing a bit of shopping. Otherwise, the Chinese example, right? If you give a Chinese consumer the kind of tax break that we have given, they will save all of it. right? Which is called as the paradox of thrift. That you get the money, it's saved or delevered, you don't spend
This
it.
is India of 1990s.
Exactly.
Whatever you got, you saved it.
Exactly. So in that case, such a stimulus or such a tax cut won't work at all. That's the last thing the Chinese government should do. Coming back, I think the prospect of rate cuts, right, rates getting easier, right, which is I think on the anvil. I don't know what happens on Friday, but hopefully over the next few months and quarters, that's the direction that we are traveling in, right? So the fiscal has given you a boost. The monetary policy will hopefully be supportive. You will have some sort of pay revisions which happen for the government employees in FY27. All these things put together, I think help things where you are buying discretionary. Buying a house is aspiration. I understand people don't make a house buying decision just because rates have been cut 25 basis points. But these are long cycles. I mean, almost nothing happened for 7-8 years in terms of the real estate market in the most part of last decade. That is now looking up.
Okay. Well, so the theme is perhaps, I mean, we've been saying this on air, I think from Saturday, that 2021, if you bet, you started buying into build India stocks, defense, infra, railway, you made money.
Yes.
Now is it time to switch and say, buy consume India stocks?
It's a great question. So I used to have this chart in my in one of the decks that we used to have, which was the Larsen versus Hindustan Lever chart, right? And if you look at the 2000s, right, it was a lost decade for Hindustan Lever. Nothing happened, and Larsen was, go-go. The decade from 2010, I'm giving you broad numbers. From decade from 2010 to 2020, it was all about lever, and Larsen was probably going sideways. That reversed, as you rightly said, something in 2021-22. Is it time to reverse that trade? My answer is no. Is it time to get a bit more nuanced about that trade? The answer is yes.
So it's time to reduce exposure to Larsen and increase exposure to HUL, but don't flip.
Larsen types, HUL types.
Okay, of course. Just putting
and I'll give you the logic behind this, right? So what is
why do you say Larsen types and HUL types? Why not Larsen and HUL?
Sure, Larsen and HUL per se. I wouldn't own HUL today at all, but which is why I said HUL types. So the logic on Larsen is simple, right? Everybody's getting worried that capex growth is 10%, which is the end of the public capex story, so to speak, and now there are freebies being given out. So again, if you look at numbers, the revenue expenditure growth is 7%, and if you take out interest from there, it is 4%. And capital expenditure is still growing double digit in line with nominal GDP. If you add the states, which are important parts of capital spending, that is still a reasonably good number. What happens is when some of the stocks that you mentioned, the defense, the railway, and this, that, and the other, that gets bid up to 80, 90, 100 P, what matters is not growth. What matters is the rate of growth or the second derivative of growth. So when a 25% capex growth at the center comes to 10%, the stocks derate. You don't want to be...
Just say that again.
So when the second derivative of growth, right, which means the rate at which growth is happening. So let's say all through F21 to F24, public capex growth, the CAGR would be 20%.
Yes.
Right?
Yes.
In FY25, that number will be maybe double digit. In next year also, it will be double digit. So the rate of growth has...
Alright, then moving on, let's get to news coming in from outside the world of stocks. Then Google has announced updates to its Gemini family of large language models, including a new product line with competitive pricing to low-cost artificial intelligence models, the likes of Chinese rival DeepSeek, and it has also released Gemini 2.0 Flash to the general public after previewing it to developers in December. Moving on, then, Donald Trump has signed an executive order that intended to ban transgender athletes from participating in girls' and women's sports. The order gives government agencies authority to deny federal funds to schools that allow transgender athletes to compete on women's teams. Alright, moving on, then, Bangladesh's Home Advisor, Lieutenant General Jahangir Alam Chaudhry, claims that the interim government is doing everything they can to bring back ousted Prime Minister Sheikh Hasina and others from India under the extradition treaty.
Well, on that note, we'll wrap it up on this edition of Market Cafe from the team that put this show together. Thank you so much for watching. As we bid you goodbye, you stay tuned because the market takes all the action forward.